Finance Term 2. This is Dr. Kulbir Singh, your faculty for Corporate Finance this term at IMT Nagpur. In this video, we will deal with financial decisions made by financial managers in an organization. Corporate finance is a branch of financial economics. Corporate finance deals with how corporations make financial decisions. Financial decisions are of three types: investment decision, financing decision, and dividend decision. Investment decisions, also called capital budgeting, is basically about spending money on real assets. Financing decision is about raising money from various sources of finance, either within the country or outside the country. And dividend decisions is about distribution of money, either retaining it or distributing it to its shareholders. To carry out business, a firm needs real assets. Assets are of two types: real assets and financial assets. Real assets are in turn of two types: tangible assets and intangible assets. Tangible assets basically consist of plant and machinery, land and building. Both of these assets generate future benefits. Intangible assets consist of brands, patents, copyrights, etc. The other type of asset is financial asset. Financial assets are basically financial securities like bonds, shares, debentures, loans, etc. These financial assets generate a series of cash flows over a specified period in the form of interest payments, principal amount, dividends, capital gains, etc. to its holders, that is, investors. These financial securities are issued by corporates and financial institutions. These securities are in turn purchased by individual investors like you and me, financial institutions like mutual funds, insurance companies, banks, pension funds, etc. So, to carry out a business, firm needs both types of real assets, tangible assets and intangible assets. This comprises investment decisions or capital budgeting. However, these real assets do not come for free. One has to pay for them. So, a firm has to finance these assets from various sources. This financing can be done through borrowing or in the form of equity or internal funding. Borrowing can be done from banks or from the investors. Financing in the form of equity can come from existing shareholders or new shareholders, and internal funding can come from the reserves and surplus. A firm can take loans from banks in the form of borrowing, or the financing can come from investors. The investors can be public or private. In case the borrowing is done from public investors, then it is in the form of bonds and debentures. In case of private investors, it is in the form of private placement. Financing from equity can come from existing shareholders in the form of a rights issue, while from new shareholders it can be in the form of FPO or IPO. FPO is when a firm has already issued equity share and wants to issue more equity shares to raise money. IPO is when a firm raises equity issues first time in the market. The third form of financing is internal funding, which basically consists of retained earnings in the forms of reserves and surplus. These various Sources of financing comprises of financing decision. It deals with how much finance to be raised, when to raise, and from where to raise. Another equal important decision in financing deals with the proportion of borrowing and equity. That is, how much debt we had to take and how much equity we had to take. This mix of debt and equity is referred to as capital structure of a firm. The investment in assets generates revenues and cash flows for a specified period of time. The managers of the firm can either retain cash with the company for further investment or investments in the plants and machinery, for example, expansion, modernization, or start launching a new product or service. Or managers can distribute cash or kind to the shareholders who are the owners of the firm. This comprises of dividend decision to distribute or not, or how much to distribute and how much to retain. Managers can distribute cash or in kind to shareholders. The various forms of distribution are dividends, bonus shares, or buyback of shares. Financial decisions can be thought of managing the balance sheet. For instance, investment decisions can be thought of managing the right-hand side of the balance sheet, while financing decisions can be thought of managing the left-hand side of the balance sheet. The financing decisions of investment, financing, and dividend are all linked with each other. Let us understand it with the help of an example. Hero Motor Corp, formerly known as Hero Honda Motors Limited, one of the largest manufacturers of two-wheelers in the world, recently announced its decision to set up a two-wheeler manufacturing plant in Andhra Pradesh with a cost of 1,600 crore, which will produce 1.8 million, that is 18 lakh vehicles annually. The question is how it will be financed. Though the company's sources are silent on it, one can still make out the financing decision of Hero MotoCorp. If we look at the debt-equity ratio as on 31st of March 2014, it is 0.1, which basically means that for every 1 rupee of equity, Hero MotoCorp has 10 paisa of debt. While its long-term debt to equity is close to zero, which implies that the firm is debt-free. The firm is entirely financed by equity funds and no debt, which means that to invest 1,600 crore in the new plant, the firm can easily take extra debt, and banks and financial institutions will happily give it because it has a very good equity capital of 39.94 crores, while its reserves and surplus is 5,559.93 crores. So taking extra debt is not a problem. So firm Hero Motor Corp can invest 1,600 crore in new plant easily by taking more debt on its capital structure. However, the reserves and surplus consists of 3,414.14 crore general reserves. And this 3,414.14 crores are sufficient to meet the investment requirement of 1,600 crores. What does it mean is that the financing is entirely through internal funds. And this is a typical case for all Indian companies. If you look at its dividend decisions, the firm in financial year 2014 earned a earning per share of 105.61 paisa, while his dividend per share was 65 paisa, which implies the retained earning EPS minus DPS is 40.61. So retention ratio is 38%. In other words, Hero MotoCorp is earning good profits per share, also paying some dividend, but also retaining 38%, close to 40% of its earnings. So if a firm is able to retain earnings of 40%, close to 40% every year, that firm can meet its future growth requirements through internal funding. Thank you for watching this video. This is Dr. Kulbir Singh at IMT Nagpur.